Welcome to the Global Market Analysis for today, July 27th, with Juan Maldonado and myself, Jody Samuels. Today was a very interesting and timely webinar in light of the FOMC meeting earlier. So let's get right to it. Please read the disclaimer. So we always start by showing you what the key fundamental drivers are, and we give you a big picture view on oil, stocks, the dollar, and gold, the dollar meaning the euro as a proxy for the dollar, followed by a thorough Elliott Wave analysis on these markets by Juan, our Elliott Wave strategist. But today, the key event driver was the Fed, and the market reaction to the Fed was very, very interesting, and we're going to discuss that. So really what the market is looking for is when will the Fed rate hike rates, and whether we're on a risk-on versus risk-off environment. And today we saw some mixed signals here. And how have the markets been affected, and what is the view going forward? So the Federal Reserve left its benchmark interest rate unchanged, but it issued a very upbeat assessment of economic conditions that suggested a growing chance of rate increases later this year. So in its July policy statement after a two-day meeting, it said that the economy has overcome wobbles this year and that job creation has increased with moderate economic growth. Now, that can mean that it overcame the wobbles of BREXIT. It can mean any number of things. And the key phrase that was used was near-term risks to the economic outlook have diminished. That was the key comment in the statement, although it did add that the Fed remains wary about the weakness of inflation and about global economic and financial developments. Absolutely, they have to be worried about that. So the recent data which they noted indicates that the labor market has strengthened and that economic activity has been expanding at a moderate rate, yet pockets of weakness remain. And what was also highlighted or what is really key here is what happened with interest rates during this statement. So now let's just have a look at what actually happened in the markets first and then interest rates. Actually, let's start with this. Okay, so here we have the S&P in the top left, the euro, the U.S. oil, and gold. So the 5-minute chart, just so we could see the action following the FOMC statement. So the long tail on this 2 o'clock candle, this 5-minute candle, showed that at least for 5 minutes, the initial reaction was fairly strong, that the S&P sold off, that the euro sold off, that oil sold off, and that gold sold off. But look at how quickly the markets reversed. And not only did they reverse, but they took out the previous, the highs leading into the announcement. So the initial reaction was that the economy is stronger, therefore buy the dollar. We're in a risk-on environment now, at least for the dollar, and gold sold off as well, but then it turned around. So we have to figure out why it turned around. And I know in my group, a lot of traders were asking questions like, why is this happening? So let's just delve into it a little bit more by looking at this chart, which shows the S&P on top and the chances of a December rate hike on the bottom. So initially, the chances of a December rate hike was about 50-50 when this news came out. In fact, initially, with the Treasury yield rose and spiked higher, but then fell across the board. So initially, interest rates moved up. And at the same time, Fed fund futures immediately spiked to show a 51% chance of a rate hike by December. And we can see how in the last month this has been increasing since BREXIT, since we had a low right after BREXIT. So this 51% chance of a rate hike by December was the initial reaction of the market, which caused the dollar to be bought and which caused the market to react as it did initially. But eventually it settled near the recent threshold, highlighting a 38% chance for higher borrowing costs in December. So this number came down. And the only thing, but why did the market react so viciously? Why did we have such a massive turnaround? And the only thing that I can think of is that, okay, fine, the statement is initially hawkish, but then what happens until December? What happens in the U.S.? We have an election. So that's the thing that was interesting. I think the market is already looking ahead to the election, and perhaps that's why we had such a major turnaround. And yes, the market already knows. It reacts very, very quickly to news these days. So fine, it's expecting a rate hike perhaps in December, 50-50 chance. But what happens before that? Is the Fed going to raise rates in September? Maybe, probably not. Why? Because we are having an election in the U.S. And I think that's why the market's turned around. So you can think what you think, and if there's any other news that came out that we should know about, that's fine, but I really didn't see any other news. But what happened, let's just go back and see what happened. Gold moved higher and the dollar sold down, so the typical inverse relationship took place. And the euro being a proxy for the US dollar, the euro screamed higher and gold screamed higher. And the S&P, in its usual risk-on fashion, that's been moving up, and we're going to look at what happened right after BREXIT and how the markets have changed since BREXIT. And oil moved up. Now, of course, the markets have flat on the day have come back a little bit. But I took this screenshot about, I guess, a half an hour ago. So let's now back up a little bit and talk about the difference between the markets now versus what happened right after BREXIT. And then, after I speak, Juan is going to give the analysis on the euro, the gold, the S&P, and oil, the Elliott Wave analysis. So let's just hold off on doing that analysis right now. The top chart shows a market breakdown for the week after BREXIT. And we had some pretty major moves. As you can see, percent change from high to low price, we had some major moves. But looking at the S&P, we're taking one instrument at a time, one asset class at a time. The S&P traded to a low of 1990. And looking at the last, hang on a second. Somebody is trying. Can you please watch yourselves, guys, here with taking control of the screen? No. Okay. Looking in the chart below, what has the S&P done since? So the month lows, right, 1990, as we said. But where's the market now? This is today's this column is the 12 o'clock close. So I took it before the FOMC statement came out. So this is the 12 o'clock close. So the S&P continued to move higher, as we all know. In fact, from the opening of the month, which is right after Brexit, to the closing of the month, and I just took it from June 27th to July 27th, the S&P is up 7.65%, just based on these two prices. The euro pretty well stayed the same, but couldn't hold the higher levels, so that sort of, traded softer during the month from the pre-Brexit highs of 114. And now, of course, the euro did turn around a little bit today. It's up from the lows. Oil was very interesting because oil had a really tough time at the $50 level, and we saw what happened to oil over the last month. It's very, very soft. And gold is holding its own and is doing pretty well. Okay, so that's a comparison between the markets post-Brexit to today. So the risk-off, the three-day risk-off environment that Brexit posed has been erased, and the markets have taken on sort of a risk-on, at least in the stocks, the S&P, and the other stock markets. So now let's move on a little bit and see what we have next. This is the correlations of the four markets that we're covering: the euro, oil, S&P, and gold. And the only thing that I can note here is that oil and the S&P were tracking very well together up until Brexit, and then they diverged. And oil moved down where the S&P moved up. So the oil is trading on its own due to supply issues, and the S&P and oil diverged. Now, if you remember, the Fed was very, very concerned about the price of oil and how it collapsed, and that brought instability to the markets. So therefore, it was a good thing for oil to trade higher. But I think oil reached a certain level where $50 and it just couldn't trade any higher, and the market just said it's just not going any higher. And look at the increase in the supply. So therefore, oil sold off, and that caused an inverse relationship between the S&P and oil. It seems that the usual relationship between gold and the dollar is still holding, and I'm just using the euro as a proxy. Naturally, if you look at some of the other dollars, if you look at the Aussie, the Kiwi, the Canada, and the British pound, so not everything is trading in straight dollar moves. There is a lot of cross action, which we really don't get into during this webinar. So that seems to be the major thing that has happened, is that oil, if you're trading, we did say for many, many months, if you're trading oil or if you're trading the S&P, make sure you look at the other instrument, oil or the S&P, especially if you're day trading, because you're going to see a similar correlation. But we're not seeing that right now. Actually, we're seeing an inverse correlation, so you might want to look at it for the inverse correlation. It might help. And this is the euro going back 5 days. Very, very interesting. And we're going to, we will have the Elliott Wave analysis, but look at how for the last 5 trading days, the euro stayed within a pretty narrow range. And then look what happened today. The euro actually made a new high on the week. So let's see what the Elliott Wave analysis is on that shortly. And if we look at the pound, I don't think I updated this post. I didn't update this. I think the last update was around 1 o'clock, so not post FOMC. Well, maybe 1 o'clock or 2 o'clock. Okay, but not after 3 o'clock. So the pound has sort of stabilized at the lower levels, but I wouldn't get too complacent buying the British pound close to the 130 mark, only because we just don't know what's coming around the corner for the pound, and I view this as a risky trade to be buying at 130 just because it's a psychological big number. I would rather see the pound trade higher and maybe look and then see what news is coming out and look for levels to. I don't know. I don't have a strong opinion on the pound actually. I'm leaving it alone personally. Okay, and then oil, you can see that the trend has been down, as we discussed. It just didn't want to hold, it couldn't hold that $50 level, and we've dropped quite substantially, even over the last week, okay, almost $5. And then the S&P, we talked about, we are flirting at these higher levels after the S&P moved up post-BREXIT after selling off. Let's see what the outlook is when we do the Elliott Wave analysis. And then the last chart that I'm going to show before I turn it over to Juan is gold with the euro overlay. So this is the 30-minute chart, just taken like 10 or 15 minutes ago. And you can see how the dollar is inversely correlated with gold. As gold moves higher, that's the candlestick chart in the background. The euro moved higher, which means that the dollar is selling off. So dollar selling off, gold higher. So I think it's going to be a very interesting week as the market digests this news and sort of figures out, you know, what happened and why the market reversed. I think it's because it's an election year, but we'll see what other strategists have to say. And the key is, are we going to see this sort of follow through going forward into next week and for the remainder of this week? And for that, let me turn it over to Juan, and we will see what the Elliott Wave view is. It seems that we're not hearing Juan. I'm not sure why not. Juan?
Hello, can you hear me?
Okay, now we can hear Juan. Thank you.
Okay, good. So I was saying that thank you very much for being here. I am here showing the Euro-USD weekly chart. We have the price action coming down from the previous high, from the 140.10 all the way down to the 104.57. That was a huge drop that happened since May 2014 and ended around March 2015. After that, the euro has been consolidating. It has been taking the shape of a triangle. That triangle in Elliott Wave we call it, we're going to have the internal structure as a 5-wave sequence. If you're new to Elliott Wave, the way we count triangles is with 5 waves, A, B, C, D, and E. So there we have our 5-wave sequence. Each of those waves are going to have, of course, waves inside, because the idea with Elliott Wave is that the markets are fractal and that we can go inside and count those waves. So the first structure up is with A, then the B, the C up, and we are currently in the B wave. Our plan is to find the end of the B wave on the weekly chart. Of course, we can follow the pricing side, and I'll show you in a second on our time frames. But as a target, we can think about the area of the 107, 90, 108 area for this move down for the B wave. And once the price reaches the support, we need to check the price at that moment. We need to see if it's reacting, if a candlestick pattern starts showing up. For example, a morning star, a hammer, or a bullish engulfing candle at that level. For now, we can focus inside the price action and find some nice setups in this leg, inside the B wave. But always is important to understand the higher time frame, the weekly, then the daily, then the 4-hour chart, and you continue going lower and lower. And if you are day trading, you will keep in your chart all the waves coming from the weekly. I'm going to show that in a second. Okay. So now that we understand the weekly chart, let's go to the next time frame, that will be the daily chart, in order to find out what is the structure inside for that B wave. Good. For the D wave, what we are suggesting is a 3-wave sequence. To keep it simple, just a 3-wave down, because we are in one of the legs of the triangle, so we will need to have 3 waves. So this is the structure that we are suggesting. 3 waves up. Invalidation of the setup will be if the price starts moving above the 111.83, that high during July. But we will see in a second the internal structure. So that's the main structure on the daily chart. So it's clear. The trend is bearish. We can see that the trend is bearish because if we look to the left, the last low was here around the 111.04, then a retrace that couldn't make a new high, and the price right now is trading below the previous low. That is a bearish trend. Great. So what we're going to do on the next time frame is that the current leg, we're going to label this as another 3-wave sequence. 3 waves up, like this. So it's actually pretty simple because we know that inside the triangle, the price is likely to create 3 waves everywhere. So let's go to the 4-hour chart, and we are going to understand better this market structure. On the 4-hour chart, we have been following another nice triangle. So let me here, I'm going to show more waves, and I'm going to hide again some waves. Okay, so this is the current market structure on the 4-hour chart. The price after the BREXIT complex scenario, the price did move down and then it started to consolidate. This consolidation took the shape of a triangle, on the 4-hour chart. So there we have A, B, C, D, and E. 5 waves for the triangle. After the E wave, precisely there at the triangle area, the market reversed. It created a 1 to 3 pattern reversal and started the move down. Then the price did the breakout of the continuation of the triangle. It went to the low of the 109.50 area, and today after the Fed, it started to move higher. The internal structure for this wave 2, the one that we are using, will be a flat. This is an expanded flat. So let's go to the hourly chart and we can understand better the price on the hourly. The price did a move down of a 5-wave sequence. 1, 2, 3, 4, 5. So there we have 5 waves. We have something called divergence between 3 and 5. So everything is in the right place. And then the price started to make the leg up. A 3-wave sequence down for the B wave. Then the price went up, was choppy, this consolidation, and after the Fed, boom, it started to move higher. So now we know that this is likely to be just a retrace of the previous wave 1. The technique to find some targets during the move up is using the Fibonacci retracement tool. So here we have it. According to the Elliott Wave theory, the wave 2 is likely to retrace 61.8, 78.6, 88.6 of the previous wave 1. In this case, for now, we're looking for the 61.8, but with the price action that the market is showing after the Fed, this is looking extremely bullish. So we can have a deep wave 2 around the 78.6 or the 88.6 area, because those candles with that strong body inside, it means that a lot of traders are buying the euro after the Fed report, and this is adding momentum to the market. If you are day trading during these days, the best strategy will be to look for the retracements, analyze each small retracement inside, find reversals, find straightways in the stochastics, and continue with the trend. Follow the trend, because the market is trending on the hourly chart, and also we know that it's trending because look, today it did this breakout of the 110.30 area, this beautiful 1 to 3 reversal pattern right there. So the plan for this upcoming weeks will be to follow the wave 2, watch the price at each retracement, never try to short at the retracement, wait for validations, wait for confirmations. Start drawing your trend line and wait for the wave 4 in order to have a nice channel to follow the bullish move. So let's follow the Euro USD during this month to the upside for the wave 2, but be ready, because once the market starts showing divergence and breakout of the trend line and reversal patterns, we can expect the move down in order to complete the weekly triangle B wave. The next instrument we are going to check today is the S&P. The S&P, from the daily chart perspective, actually I want to show quickly the weekly without a wave count, just to have a better perspective about the area that the price is testing. So the price last week was green and is having some trouble at the resistance of the 2181. Of course, this is a continuation breakout, where the price did the breakout right here at this area and is creating new highs on the weekly chart. But something that we have been working with the Elliott Wave count that I will show in a second inside is that seems that this is likely to be a corrective wave, which means that in the future on the weekly chart, we may see something like this. An expanded triangle or expanded flat. So that would be the leg down, this move up that we are seeing, and then another leg down. So the question is, if this is right, when and where we can start thinking that the price could make that retrace? For that, we are going to use the Elliott Wave analysis. Let's go to the daily chart now with the wave count. With the wave count, we're seeing that the price has been losing momentum since the beginning of the move on the daily chart. Let's take a look at the oscillator. So there we have some divergence since the beginning of the move. The price is having some trouble at that high around the 21.75. So let's plan together some scenarios on our time frames to be ready for the upcoming moves. On the 4-hour chart, the price is extremely choppy at the top. It's having problems, of course, is losing momentum because on this time frame we are seeing also the divergence since the beginning of the move. We have this as a corrective wave. The price has been trading since the mid-July, all the month, completely sideways in this choppy and complex market. This is a box. The other detail that we are checking at this top of the market is that, yeah, we have divergence, but also we have some nice patterns. For example, here we have a head and shoulders reversal pattern. The neckline will be here, and that could be a nice validation in order to find the change of trend. If for some reason the price holds above the level and happens the opposite, for example, here we have another breakout of the high, a bullish continuation, and it starts adding momentum, and the awesome oscillator starts growing, then we can think in a bullish continuation. So to recap, a breakout of the head and shoulders will be a 1 to 3 reversal plus confirmation that the move up was likely to be corrected because of divergence, because we have small candles, because the market is choppy, is losing momentum. If the price, instead of making that breakout, starts gaining momentum to the upside, we will activate all the trend following techniques in order to be part of the move. But be careful if you trade inside this box, because the volatility is high inside a lot of wicks. It's complex to trade inside that pattern, and it's better to wait for the breakout on the S&P. The other market that we're going to check today is oil. We really like the price action of oil. If you have been following our work, our analysis, we have been saying that the previous move up was likely to be a corrective wave because it was losing momentum, because we have some small candles at the end. But finally, it did the confirmation of reversal with this beautiful 1, 2, 3 reversal pattern on the daily chart. So that's quite easy to see that the price before was trending up, and after the 1 to 3 reversal is trending down. If the market is trending, we need to follow the price with a strategy that follows the trend. For example, we use the wavy tunnel, which is great following the trends. The price is bearish, and we have the main wave count from the medium-term perspective as a three-wave sequence, A, B, and C. There is our projection, but we are always watching the market every day to find any reversal or any change of trend. For now, the FIBO projection for our wave 3 that we are expecting, our target at 41.10, that is the target that we have been looking for. And if the price is able to break out the level, then the 200% 38.87 will be the next move. So we need to see the price making the five-wave sequence without making breakout of the trend line. That is important because we are in the impulse, so we don't want to see a candle closing to the other side. That can change the wave count. Anyway, this is our main wave count, and we can go to the lower time frames to check what's going on inside the price action. On the 4-hour chart, we are seeing a beautiful impulse, fantastic session today. Even with the fundamentals and everything, we have the waves 1, 2, 3 green, 4 green, and 5 green to complete our internal wave 3. The markets are fractal, and we can have waves inside the waves. We can counter the waves inside the waves, and we can use all these Fibonacci analysis. Our target at 42.41 has been met. The price is trading a little bit lower. To be careful, because we consider that soon the price is going to start making a retrace for the next wave 4. After that, another continuation down. So it's just a matter to have a good and easy to follow strategy, trend following strategy. So you can check each retrace with the FIBO tool with some oscillators, and then be able to find the proper time to follow the trend or identify if the price wants to reverse. Gold, this is our daily wave count. We have been following the trend almost since the beginning of the move, when we found that the previous leg ended. We have a bullish view of the market. There are some details pending in order to confirm our ideas, but on lower time frames, they will be the same. What I mean is that for gold, after all the drop before, the price now is doing a leg up, or did a leg up, then 3 waves consolidation, and now we are in another leg that is active, is live. The leg, in order to validate our view, we would like to see a strong move up for the wave 3 that is starting. Something powerful, something that could increase the momentum of the market, that could increase the oscillator and everything to validate there is a wave 3. So we are waiting for that wave 3 to see if our daily wave count is right or not. But the good news is that from lower time frames, the wave count will be the same. Let's go to the 4-hour chart. On the 4-hour chart perspective, our mission this week has been to find the end of wave 2 blue. The wave 2 ended today. It ended at the 1310. The price was choppy at the beginning of the week, the end of the previous week. It did a leg up, a retrace that failed to make a new low, and then today, after the statement, boom, 1 to 3 reversal with a nice body breaking to the upside, the 1 to 3 pattern. So if the price was doing a leg down, a retrace, and a new move down, and it starts doing the opposite, of course, that's a reversal. And also, this is like an inverted head and shoulders. Here is the neckline. Here is shoulder 1. This is the head, and this is shoulder 2. And we are right there at the classical confirmation of the reversal. And the trend, if we look to the left, is bullish. So actually, what the price is saying is that this was just a corrective consolidation, and the price is ready to continue to the upside. Anyway, the targets, we always like to look to the left to see the previous high. That's an easy way to find the resistance. That's the 1372. But also, of course, with FIBO, we can get some nice targets. Because this is going to be the internal wave 3 that we're expecting as the strongest. The next destination will be around the 1409. That is the 423.6% of the previous wave 1. This is going to be an extended wave, and we're expecting that bullish move to continue. On lower time frames, you can follow the trend step by step, analyze each retracement, and make sure that you are seeing the same, and that the momentum is getting stronger, and that the retracements are just shallow, sideways, and find the continuations. Great, that's our analysis, Elliott Wave analysis for today. Now Jody will continue with the webinar. Thank you very much.
Thank you, Juan. Thank you for sharing the views on what we think will happen over the next few weeks, over the next week in particular. So we just took a look at the euro, gold, oil, and the S&P with some very interesting trigger points that you can take away from this webinar and go back and analyze yourself. And I'm sure you learned, some good information about how to look for market turning points and how to get confirmations of a change in view. And if you want to hear more of this analysis on a daily basis instead of a monthly basis, if you can see my screen, please join us in the ElliottWaveDesk.com. That's our premier wave counting service, and actually one provides a video every single day similar to this analysis on 13 different markets, not just the 4 that he analyzed today. So check us out, ElliottWaveDesk.com. We are a full educational institution. We teach Elliott, Fibonacci, and harmonics using our wavy tunnel strategy. So you may be interested in joining us for that as well. You can always email us you can email Jody at fxtradersedge.com, Jody, if you want some more information or if you want to set up a session, or just check out the ElliottWaveDesk.com. So that concludes today's webinar, and I want to thank you very, very much for being here today and for participating with us. And we will see you in about a month, because we've been doing these webinars pretty regularly. So thank you very much. And since this session was recorded, as noted, we will be sending out the link so you can look at it again. Okay. Bye, everybody. Thank you again.